Hello everyone, and welcome to Virginia International University's MBA 605 Auditing course. Today we're going to start talking about the ideas and concepts surrounding materiality and risk as covered in Chapter 9 of your text. We'll discuss this concept of materiality and how it applies to the audit. We'll talk about the significant level of judgment that goes into determinations around materiality. We'll discuss risk in auditing, and we'll discuss the audit risk model and its components. We'll also discuss the impact of engagement risk. What is that, and what does it have to do with acceptable audit risk? There are several factors that influence the assessment of inherent risk, and so we'll talk about what exactly is inherent risk and those factors. We'll discuss the relationship of risk to audit evidence, and also how materiality and risk are related and integrated into the audit process. And so in discussing materiality, it's important to note that the audit report we ultimately issue at the end of the audit references free of material misstatement. The Financial Accounting Standards Board Concept Statement Number 2 defines materiality as the magnitude of an omission or misstatement of accounting information that, in the light of surrounding circumstances, makes it probable that the judgment of a reasonable person relying on the information would have been changed or influenced by the omission or misstatement. And so we can see from this definition that there are several issues that come to play in the determination of materiality, and that is actions or judgment of a reasonable person, that this idea of probability or probable that some sort of action or decision would have been changed or influenced on behalf of the decision maker. And so absent a client remedy of the material misstatement, the auditor will most likely issue a qualified or adverse opinion. And so what we're saying with that is that the auditor is responsible for determining whether the financial statements are materially misstated. If they come across a material misstatement, one that in their judgment is material, they will bring that to the client's attention so that corrections can be made. And as we said earlier, if the client does not remedy the misstatement, the auditor will most likely issue a qualified or adverse report, which would not be what the client would want. And so here we see the steps in applying materiality. We have the step 1 and 2, which are really done during planning, and then steps 3, 4, and 5, which are done during the evaluation of our testing results. And so this first step, where we set the preliminary judgment about materiality, is normally performed during the planning phase of the audit. Here, the auditor must make a determination based on individual misstatements as well as the aggregate misstatement amount. And when we talk about the factors affecting judgment around whether an amount is material or not, we have to keep in mind that material is a relative concept, not an absolute concept. So we cannot say that because an account balance is misstated by $10,000 or $100,000 that it is a material misstatement. We have to interpret that relative to other conditions surrounding that account. We need benchmarks that in order to evaluate our materiality, and a lot of qualitative factors also impact materiality. And so the SEC Staff Accounting Bulletin number 108 requires the auditor to consider both qualitative and quantitative factors in assessing materiality. And so what we're talking about here is that there are some issues that could come up that may render material a quantitatively small misstatement, which is saying that, well, it may be misstated by a small amount, but because of these other considerations, it is still considered to be material, such as loan covenants that contractually set terms and conditions around loans. If we're in violation of those, it doesn't really matter how much we're in violation of them. The fact is, we're in violation of them. Where we find that an illegal act has been concealed, well, it doesn't matter that the financial amount involving the act is immaterial. The fact is that it's been concealed, and that is something that would concern the audit committee greatly, and so we would want to report on that. And so you can see how examples of items in each of these areas, while they may be small in dollar amount, could still be considered to be material. And so other factors that may influence the auditor's materiality threshold include the control environment, entity-level controls, the quality of information systems, and the existence of an internal audit function. So while materiality may be allocated to balance sheet accounts, the auditor must be mindful of the impact on the income statement, since most balance sheet adjustments will also impact the income statement. In addition, the investment community is often more sensitive to a company's earnings rather than the balance sheet. And so here we're talking about this idea of misstated accounts, and we can say that an auditor can usually determine between known or likely misstatements. And a known misstatement is when we can determine what the amount is misstated in an account. Likely misstatements are generally based on judgmental differences and projections of misstatements from audit samples. So again, we have this idea between a known misstatement and a likely misstatement. So when we talk about risk, we want to keep in mind that auditors accept some level of risk in performing the audit. That's a necessary evil of the function itself. Risks exist, they're difficult to measure, and they require careful thought and response. And so we need to, as we evaluate the risk and the significance of the risk, we need to understand how that impacts the audit activities, the size of samples, what's communicated to the client, and other considerations, which get us to that proper risk response is critical to achieving a high quality audit. As you recall, the second standard of fieldwork requires auditors to gain an understanding of the client's business and assess client business risk. This assessment in turn helps us with respect to the level and detail of evidence that we will need to gather. And so this audit risk model for planning purposes is one of the standard risk models that we use in the financial audit function, where we say that the planned detection risk is equal to the acceptable audit risk divided by the inherent risk times the control risk. And we'll talk about each of these types of risks throughout this session. And this illustration provides us with a model, this audit risk model we just talked about, where we can see that it's important to understand the client's business risk and their industry. That involves understanding the industry and the external environment, the business operations and processes, the management and governance of the entity, the objectives and strategies of the entity, and then the measurement and performance that is inherent to that entity. As a result of understanding that client's business and industry, we're able to assess the client business risk. Once we're able to assess the client's business risk, we're able to break that down into the elements of risk of material misstatements, which are the inherent risk and the control risk. And as you recall, what we talked about earlier was that we break down the business into certain business functions or cycles. And what this shows us, or what this illustrates to us, is how we're able to assess the inherent risk or the control risk or the acceptable audit risk and plan detection risk across the different functional areas such as sales and collection, acquisition and payment, or payroll and personnel. Here we've engaged that same idea with respect to inherent control, acceptable audit, or plan detection risk types and assessed them across the inventory and warehousing cycle and the capital acquisition and repayment cycle. So plan detection risk is the risk that audit evidence for a segment will fail to detect misstatements exceeding tolerable misstatements. Plan detection risk is dependent on these other three factors in the model, and that is the inherent risk, which measures the auditor's assessment of the likelihood that there are material misstatements due to error or fraud in a segment before considering the effectiveness of internal control. We have control risk, which measures the auditor's assessment of whether misstatements exceeding a tolerable amount in a segment will be prevented or detected on a timely basis by the client's internal controls. And then we have acceptable audit risk, which is a measure of how willing the auditor is to accept that the financial statements may be materially misstated after the audit is completed and an unqualified opinion has been issued. Often, a firm defines their image by their client base. Engagement risk is the risk that the auditor or audit firm will suffer harm after the audit is finished. In other words, it's the risk of a lawsuit or unfavorable publicity resulting from being associated with the client, where, after an audit opinion has been issued, it's found that the opinion was issued in error. And so here we speak to this issue about the impact of what that engagement risk on the acceptable audit risk is, and we say that auditors must decide the engagement risk and then use that risk to modify the acceptable audit risk. And we talk that engagement risk closely relates to client business risk. And so this is where the auditor will place reliance on prior experience with this client and management's attitude toward controls and governance, accounting standards, and the audit relationship. And this table provides us with illustrations of what an auditor might do when they are coming to some sort of an assessment on issues such as surrounding the acceptable audit risk. For example, if we're looking at the external user's reliance on financial statements, we may want to, in order to assess acceptable audit risk, read the minutes of the board of directors meetings to determine future plans or discuss financing plans with management. If we want to gauge or assess acceptable audit risk with respect to the likelihood of financial difficulties, we may decide to analyze the financial statements for financial difficulties using ratios and other analytical procedures, which we'll talk about. We also want to assess management integrity. So there we'll follow the procedures we discussed in Chapter 8 for client acceptance and continuance decisions. And so when we talked about inherent risk, we really talk about the risk of a audit failure as a result of factors that are inherent to or incorporated into the client's business. And we can assess those by looking at issues and factors surrounding the nature of the client's business, such as industry practices, non-routine transactions, or makeup of population. We can also get a good feel for inherent risk based on our audit experience with that client, and we can also rely on that client's culture to help inform our assessment of inherent risk. With respect to culture, we look at things like related party transactions, or factors related to fraudulent financial reporting, or factors related to the misappropriation of assets. So we can get some feel or understanding of this inherent risk by relying on some of these steps. And so as control risk increase, the auditor will want to gather additional evidence to minimize the risk of failing to find a material misstatement. And so what we would look at there is to gather additional evidence. So we may expand the number of transactions we look at. We may expand the number of accounts that we include in our auditing. And so as we continue to assess this risk, and it becomes an iterative process, we make an assessment during our initial planning phase. We make an assessment as we continue to understand the client and understand their internal controls. And then as we move through substantive testing, we continue to make risk assessments. And as through those continual iterative assessments, we find that we may need to change the audit to respond to risks that surface. We may find that the engagement requires more experienced staff. And then we also may find that the engagement will review more carefully than usual as a result of the risks that become apparent through the conduct of the audit. So both control risk and inherent risk are typically set for each cycle and each account, and often each audit objective, not for the overall audit. Inherent risk factors will have varying degrees of impact on balance sheet accounts. For example, inventory has greater risk than fixed assets in a wholesale distribution company, yet the materiality threshold for both accounts will most likely not be the same, since a correction to either account will impact the income statement. And so in this table, we're just simply trying to show the relationships of risk to evidence. And so, for example, in situation 1, if we have acceptable audit risk, we may have high levels of evidence. If we have inherent risk low, then we'll allow that to impact the amount of evidence that we require. If we have control risks that are low, and then high plan detection risk, will also allow those risk assessments to impact the amount of evidence we require, which under situation 1 and those assessments of those individual risks, we see that the amount of evidence required, our last column out to the right, amount of evidence required, would be low. Compare that with situation 3, where we have high inherent risk, high control risk, and low plan detection risk, where we would require a high amount of evidence. And so due to the judgmental nature of evaluating and assessing risk at the beginning of the engagement, the actual level of risk achieved at the end of the audit is never really known. And we're talking here that auditors develop various types of worksheets to aid in relating the considerations affecting audit evidence to the appropriate evidence to accumulate. So as the auditor perceives a greater risk that controls will not detect a material misstatement, the auditor's risk tolerance for detecting material misstatements will decrease or tighten to minimize the risk of error. Similarly, if detection risk decreases, the auditor will need to gather more evidence to minimize the risk of failing to find a material misstatement. Although the risk assessment is performed during the planning phase of the audit, The auditor needs to recognize changes in the client's business that could impact or change the preliminary risk rating. And there where we talked earlier that this revising risk and evidence becomes an iterative process that we have to, it's dynamic and we have to pay attention to it all the way through the audit. We can't just make an assessment, decide a level of evidence, and then proceed through the audit without revisiting that decision routinely. And so this covers Chapter 9. Please go back and read the text and make sure you're comfortable with all of the different concepts. We just covered the high-level ones in this discussion. And again, these discussions are not intended to preclude or substitute as readings of the chapter. And thanks very much.